In 1947, by some accounts, 4 rupees would have got you a single US dollar. Today, it will take you 87 rupees for the dollar. In the last couple of months, the dollar has strengthened significantly amongst most other currencies, including against the Indian rupee. Why has this happened and why is it of concern to us in India? Hello and welcome back to Business Matters at the Hindu with me, K. Bharat Kumar. When the rupee depreciates against another currency such as the US dollar, exporters of goods to countries that use US dollar to pay for goods consumed, exporters from India tend to benefit. But importers would be impacted. This is of concern to a country like India where imports far exceed exports, which means for every such transaction, more and more of foreign exchange reserves would go out of the country. One big significant example would be import of oil. India depends on imported oil to meet more than 80% of its fuel needs. Currencies depreciate or appreciate depending on market forces. In some instances, their own governments devalue their currency. India has done that on 3 different occasions in 1949, 1966 and 1991. 1991 is of the most consequence to us because that's when the economy was starting to get liberalized. In that year, the Indian government devalued the rupee in 2 tranches, on July 1st of that year and July 3rd. Why would countries devalue their own currencies? According to a paper published by the Center for Civil Society, when the exchange rate is fixed and a country experiences high inflation relative to other countries, that country's goods become more expensive and foreign goods become cheaper. Therefore, inflation tends to increase imports and decrease exports. One of the objectives of the devaluation exercise by the Indian government at that time was to ensure that our exports became more competitive. Since then, the rupee has depreciated against the US dollar more or less consistently, and currently it's touching all-time lows. The Indian Central Bank or the Reserve Bank of India often intervenes in the foreign exchange market, but its stated intent is that it will not decide a certain level for the rupee, but it intervenes more to stem the volatility. So you cannot have the rupee trade at 86 rupees today and within a single session of trading go to 81 or 91 and so on. That is the RBI's stated intent. But should it be doing this at all? Or conversely, should it be doing more of this? Foreign exchange strategy advisor T.B. Kapali, who is formerly with Business Line in the Hindu group, says that the RBI should be intervening a lot less in his view in the currency markets. He says as far as the economy is concerned, the country had moved to an almost completely free market kind of setup starting 1991. But the foreign exchange market system in India is still not completely integrated with the global system. He says that a central bank for a country such as India will not be able to make a significant impact, even if it wants to, when it intervenes in the forex markets. He cites other countries that actually tweak the underlying macro policy, which indirectly impacts the currency markets, but they do not directly intervene in those markets. Let's ask him why. Why do you say that the RBI should not be intervening as much as you see it doing in the currency markets?
You are having enormous flows of money. You will be, see, for example, our trade flows, that is purely goods and services flows, financial flows in the foreign exchange market, is something like 2 to 2.5 trillion dollars annually. 23-24 was about 2 trillion. I am assuming that 24-25 it will be like imports exports of goods and services put together, the flows actually is something like 2.5 trillion dollars on an annual basis. And investment flows, that is investments through various means like foreign direct investment, portfolio investments, NRI deposits, external commercial borrowings, all these flows put together, inflows and outflows on a gross basis, that's something like 1.82 trillion dollars. Okay. No, so the magnitude of these flows is now enormous. If you compare it to say some 10 years ago, leave alone 20 years ago and all that. No, we are now talking about enormous flows, about 2.5 trillion on trade, goods and services, and about $2 trillion on capital. That's slightly more than, even more than India's GDP itself. So the size of the flows is enormous. That is because of the level of integration of the underlying macro economy with the global economy. We are importing so many things, exporting so many things, and goods and services. Now, for this kind of economy, you are now stuck with the foreign exchange, management system, where the central bank of the country plays a very major is a very major player in the markets. No, that is a kind of disconnect which is there, and it doesn't look like Reserve Bank from an official position they may not budge from this kind of position. If that continues to be their stance, we will have periodically these kinds of big disorderly movements in the markets, in the underlying markets.
According to Mr. Kapali, what the RBI is doing is effectively playing the role of a risk manager for private market participants. He says, as a nation, we are not allowing private players to take responsibility for hedging their exposures. So, when a central bank such as the RBI intervenes in the forex market just to stem the volatility, it is able to manage up to a certain point. But he says when a tipping point comes, like has happened in the past couple of years, when there are overwhelming geopolitical developments, it could be tariff trade wars between two big nations like the US and China, or wars between Ukraine and Russia, or that between Israel and Palestine, then a central bank will not be able to manage the market. He says when corporates are allowed to hedge their currency risks, and if they do that wisely and consistently over a period of time, the market is more stable. Mr. Kapali takes the example of an importer. For example, if the importer buys $100 million worth of equipment and pays the rupee equivalent, that quantum of rupees goes out of the financial system. Now, if the RBI acts as the risk manager and the importer finds that the rupee is not moving beyond a certain range for, say, several months at a stretch, then the importer ends up not hedging the risks just so as to save on the cost of the hedge itself. When global upheavals happen and the central bank is unable to manage the volatility in the rupee, then all the hedging transactions that could have been evenly distributed across time suddenly get executed within a small time frame. This actually harms the market, says Mr. Kapali.
When I do a hedging contract for a payment which is going to happen 3 months from now, when I do the hedging contract today, the demand has already hit the market today. Okay. No, likewise, if all the guys do their hedging, according to their, requirement, the overall demand for dollars gets distributed in the market over different time buckets. No, 1 month, 2 months, 3 months, 5 months, 6 months, like that. No, because of the complacency generated by the rock steady, range, very narrow range and all that. None of the entire demand is just getting accumulated. It is waiting. Now, one spark is enough. Some trigger, okay, then everybody it'll be a stampede. Okay, that's typically will cause a disorderly, highly disorderly movements. Now, this is what happened in 2009 to 11, as I said, 45 to 47. Now, oil began to go out of control. Then the underlying problems, in the Indian trade environment began to get noticed. Then 2011 middle, rupee fell from 47 to 55, one shot. Okay, 8 rupees. 8 rupees on 47 is what? Something like 20%. Okay, one shot 20%. You thought 2% will hold on for life. No, 20% fall in about 2-3 months' time. 47 to 55. Now, then after that, it fell so much, people got shocked. Then some this thing, some hedging, everything happened. Then again, it 55 to 58 and all. Again, it was in that this thing, that range. But oil markets began, other commodities, oil, everything was rising very sharply in that time. Now 2012, 13 and all, if you see, oil markets are at very high levels, crude oil. Now 2013 again, May, June, rupee fell from 55 to 65, another one shot. Okay. 10 rupees on 55 is another 20%. Okay. So, in a short span of time, about 18 months, the rupee fell nearly 50% from 45 to 65. Why? Because so much of the demand had not been distributed, time distributed in the markets through proper hedging action. Why did that not happen? Because of the moral hazard created again by the Reserve Bank of India in the previous 2 years. When you held it so tight between 45 and 47, people naturally thought, hey, what the hell, yeah? I mean, why should I pay that extra 40 paisa? Why should I pay that extra 70 paisa to hedge? See, everybody wants to save the last paisa, correct? But you do that, is what is called as being penny wise, pound foolish.
But the experts in the system are not hugely in favor of a fully free float of the rupee. In fact, several years after the economy was liberalized and almost a decade after the rupee was allowed partial convertibility, the Tarapur Committee report of 2006 still pointed out risks involved in expanding the convertibility of the rupee. Here are a few examples of the risks involved. The first and foremost risk, obviously, is to the financial system of the country. Imagine if a large bank in the country has exposure to foreign currency risks because of its own transactions or because it has lent to a company within the country, but that company has exposure to foreign currency risks. Then, if there is a wild swing in the rupee against, say, the US dollar or the euro in a very short period of time, it could impact the health of the financial system of the country. That is not something that we can afford to ignore. Other examples of risk include collecting and analyzing credit information, including knowledge of the risks to which the counterparty of a certain transaction is exposed and their capacity to efficiently manage those risks. This assumes significance in cross-border transactions. Then there could be legal risks or risk of one of the two transacting economies not having adequate regulatory controls that could hit the Indian entity in the transaction. So what to expect in the near future for the rupee? A simple answer to that is the rupee is expected to weaken, and there are some reports that estimate that before the calendar year 2025 is over, the rupee could weaken to as much as 90 against a single US dollar. In a recent article in Business Line, my colleague Gurumurthy says that the dollar is set to remain strong throughout this calendar year, which would automatically mean that the other currencies that it trades against, such as the rupee, could weaken. He notes that during the tariff war that the US had with China starting 2018, the dollar index rose about 8% from its low of 89 in February 2018 to 96.5 by the end of that year. This time around, the index had surged about 5% from 103 to touch 108 in just 2 weeks after the presidential election results were announced in the US. It is hovering around 108 at the time of this recording. Donald Trump has been sworn in as the 47th US president, and if his tariff plans convert into executive orders, it would only mean that the dollar index will move higher during the course of this year. Ironically, Trump's plans to raise tariffs would only make consumables much costlier for US consumers. This would mean that the Federal Reserve won't be at liberty to cut rates as much as it would have liked to, because inflation will remain high. This will also mean that without lower rates, bond yields will remain high, and that in turn would send the dollar index higher up this year. That brings us to the Did You Know section of this episode. The rupee, did you know, is widely believed to be an invention of Sher Shah Suri, who ruled between 1540 and 1545. He was the Afghan Sultan of Delhi and the founder of the short-lived Suri kingdom. Although the etymology of the word rupaya itself can be derived from the Sanskrit rupa or rupya, which meant either fashioned or wrought silver or a form or impression. And related to this, here's a quiz question for this episode. When did the word rupee or rupaya formally appear on Indian currency? Look out for the answer next week. And here's the answer to the question from last episode. Why did the US Congress pass the act to encourage immigration in 1864? The answer is, it was because the pace of immigration slowed during the Civil War. Interesting, right? Given what's happening in today's America. That's all we have for you folks in this episode, but worry not. With Trump back in office, you can look forward to news having a consistent flow going forward. We'll keep you updated on whatever happens. If you enjoyed what you saw in this episode, do not forget to like, share, and subscribe. Till we meet again next week, have a lovely time ahead.